Welcome to this Killik Explains finance video. This week, I'm going to look back at the last decade for equity investors and do something which is fairly unwise and look forward. I'm going to ask the question, if the next 10 years is likely to be a bit more bumpier than the last 10, what does that mean for your approach to equity investing? So, first of all, the background as usual. So the last 10 years have been amongst the best for equity investors. If you look at the American index, the S&P 500, people talk about the most hated bull market in history, but goodness me, it has been quite a bull market. One of the best runs for the American index ever, and I'll give you some evidence for that in a moment. Now this suggests simple rule of averages, mean reversion, things go back to their average over the long term. This suggests the next 10, just common sense, may be a bit tougher. I can't tell you that. I can't forecast it, not expecting a disaster necessarily, but certainly those returns from the last 10 years may not mirror repeat the next 10. So what's the best strategy in terms of approaching the next 10, whatever they may deliver? Now, simply the best. Why have I put that up there? Let's take a look at just how good the last 10 years have been based around the performance of the S&P 500. So, and I'm grateful to Michael Bennett for some of the information supplied here. So the S&P 500 has seen 342 new highs over the last 10 years, which is more than it's ever seen over an equivalent 10-year period. And the average time between them was just 13 days. So you want that to be a small number, if you like, beating 1999 to 2000 at 14 days. So more highs coming at you faster, if you like, and the average maximum drawdown was under 2%. So that's when the market dips, if you like, the best reading since 1950. So on the upside and on the downside, we've seen a fairly incredible 10-year period. Now, drilling into those drawdowns, because those are important. People don't like to lose money. We are loss averse. It's wired into us from our days on the savannah. Did a recent video on just that topic recently. There have been 176, so 177, if you measure it a certain way, drawdowns over that period. 8.5% were greater than 5%, and 3% of them were greater than 10%. So that's drops in the market, if you like. And that means that most never reached what analysts would officially call correction level. So if you're looking at, times when things have gone wrong over the last 10 years for the S&P 500, the reality is things haven't gone wrong that often. And when they have, it hasn't lasted very long, and it's been a relatively shallow dip by historical benchmark, if you like. Now, what are the observations that we would draw from that, therefore? Well, past performance is not a guide to future performance, right? Now, what that means is we've had a great 10-year run. What the next 10 years will deliver for the American stock market, and remember, when America sneezes, everyone else catches a cold, if you like, is the theory there. So that's a guide to what can happen elsewhere, but past performance, not a guide to future performance, just means that the last 10 years may or may not be mirrored over the next 10, but it will be an optimist that assume we get something as good again. And looking down, economic data is being somewhat overshadowed at the moment by the central bank put. So what's been keeping stock markets alive, very much alive over the last few years, is a willingness to believe that the Federal Reserve, the ECB and the Bank of England will step in and basically deliver something like an interest rate cut or a slowdown in interest rate rises or some more quantitative easing or not doing so much quantitative tightening. Essentially, they'll deliver something which is nice for the market, a happy pill for the market, if you like. And the fact that in the UK, the underlying economic data is a little bit ropey, as I make this video in the summer of 2019, if you look at the data and you look at where the pound is, for example, sort of plunging to record lows, the underlying economy, one could say, is not desperately strong, but the stock market continues to power upwards, lifted on a tide of central bank generosity and also a weak pound, which can help certain sectors where you've got overseas earnings coming in and so on. Now the next 10 are probably, so we can say probably, law of averages, not going to be as generous as the last 10. No one's forecasting a disaster necessarily, but there's reality for you. Sooner or later, the underlying economic data is likely to play more of a centre stage role. Now, what to do if it does? And the answer is not what RBS advised in January 2016. It's never going to be sell everything, go to cash, hide until the winter ends. All right, never a good idea. I've covered this in other videos. Market timing is notoriously difficult to do. While you're sat in cash, you're earning virtually nothing in relative terms. Getting back into the market is really, really difficult. And if you miss the best investing days, there have been plenty of studies done on this, which are fairly few and far between and tend to follow the biggest dips, you're in trouble. Your long-term returns suffer as a result. So rather than sell everything, review it instead. Just make sure you're positioned on the basis that the next 10 years may not be as generous as the last. But what does that actually mean? Well, let's look at some dips. Okay, the biggest dips have been pretty bad. All right, so in the early 1970s, the market lost 2/3 of its value. I go back that far because that was pretty horrendous. Mid-80s down 1/3, early 90s down 1/5, dot-com crashes. All right, so there have been some big dips, but the key question is the one at the bottom. How long did the pain last? And this is where the answer is not as long as you might expect. So this is a very difficult chart to read at a distance, if you like, but what it does, the pink bands indicate where the stock market has sort of gone through one of its dips, if you like. So there's one, and there's one, and there's another one, and there's another one. And actually, they don't actually last as long as people sometimes think. People's memories of stock market crashes are horrendous. God, the market went down 50%, all right? And that gets people talking. But actually, what they don't look at is how quickly, over time, it's tended to correct back on average. And therefore, panic selling or putting yourself in a position where you have to dump stocks in the middle of one of these dips is a pretty big mistake. So, a suggested approach would be what? Well, been through this before. Get a rainy day fund established. This applies whether the market's in a bull phase or a bear phase or something in the middle. A rainy day fund travels with you for emergencies, short-term cover. Then, position your portfolio to meet those foreseeable calls on capital. You know you've got money going out the door in 5, 6, 7 years' time. You don't want to be caught out if the market does take one of those sort of V-shaped dips. All right, so therefore have that money move towards cash, bonds and so on to meet that call on capital, and then leave your remaining savings invested, all right? Because basically, chances are, most of the big dips in the stock market have been fairly short-lived. People who are allocated correctly can afford to ride them out, and in the meantime, they're not sweating, worrying about the paltry return they'll be making, for example, for sitting elsewhere in cash. So there you have it, a long-term strategy to meet the possibility that the next 10 years are not quite as generous as the last 10. And as for managing foreseeable calls on capital, just to give you an example, because that's the bit people find confusing sometimes, if you're looking at funding care fees, for example, for an elderly member of the family, you know when these need to be paid, you can estimate the amount, and you can also estimate the inflation, the amount it will compound by. That is data that's available. And as the payment date approaches, all you're doing is moving money away from equities into bonds, into cash, as you realise that you've got to write the cheque that's going to go out the door to cover those fees. Same applies to education costs, any foreseeable call on capital coming up. Okay, so diagrammatically project your annual costs, net of income. Okay, make sure you take account of a reasonable inflation rate and then position your portfolio accordingly. There's a bit of judgment required in terms of how much you move out of equities into bonds and cash, but it's a judgment that will leave you roughly right, which is better than absolutely wrong and unprepared. So there you have it, editor@killik.com for any more information on that area. And if you want to watch related videos, it's killik.com/learn. And a good place to start down here will be the shares tab.